welcome to Maltbie's Minute on the Market. I'm Robert Maltbie, and the coronavirus summer drones on. Let's get to our market report, our strategy report for the month of July. We're in the third week of July. The Big Mo, that's what this market's all about, as most of our valuation indicators show a market that's pretty fairly priced. But technical and sentiment indicators show that there is some good upside continuing to happen, and we stay on the bullish side right now. Let's look at our indicators. Our market sentiment is bullish. The volatility indicators of the VIX are registering in the mid-20s. That is slightly elevated. The bull to bear ratio scores at 0.68, not even 1, 0.68. Bulls to bears. So that's contrarian. So there's more bearish pundits out there, which is good. Short interest is about twice the normal level, and that is also elevated. Technical indicators, bullish. The market shows a very healthy expansion, becoming more inclusive. New highs and new lows, firmly bullish. The NASDAQ advanced decline volume ratio, 1.5 to 1. 10-day moving averages say about the same thing. Confirming the expansion and showing a broadening of the bull market is 5 of the 6 major market indices are now above their 200-day moving averages. Liquidity indicators, neutral. Powered by 2 large M&A deals, it registered barely positive, a trickle of cash in. In terms of the driver here, we have 4.5 trillion, that's with the T, parked in money market funds. That is a very, very large amount of cash. It's about 14% of the total market capitalization, and that's about twice normal. This money, this cash is waiting to be deployed. It could end up in the market. Earnings momentum is neutral. However, it looks like we are bouncing off a low and starting to trickle higher. The chopping block for earnings estimates may be reaching a trough here at a down 26%. Valuation, neutral. The market replacement indicator shows a market at a premium. The market to GDP indicator shows the market at about 1.5 times. Not a screaming buy. The EPS yield to corporate bond yield shows that the earnings yield is a good premium to corporate bonds, and our S&P 500 target based on our estimates is 3071, about 5% down. But here's the bottom line, in the real driver, the Fed. The historic and aggressive maneuvers by the Fed, both in fiscal and monetary actions, has been impressive. Our excess liquidity indicator registers a high reading, very bullish, with another round of stimulus to be negotiated in Congress as we speak. This looks to be sufficient to overcome the virtual lockdowns in the blue states on each coast. High yield bonds look relatively attractive, but the real story is don't fight the Fed. A cliche, but if there is one, I would pay attention to. That is the one. In summary, the stimulus, the nod goes to the bull. In the area of irrelevant, annoying information, Jeff Bezos made $13 billion in the market yesterday. Are you envious? That's so much money. It's beyond comprehension. Looking at some of the market valuations in the indices, it's stunning. And the performance, wide divergences. Small caps off 11.5, large cap growth up 12, large cap value down 13, NASDAQ leading the way up 16. So big divergences between big and small. With the valuations, the P/E ratio on the S&P is 23 times, and on the microcap 12 times. So the smaller, the cheaper, I guess, if you want to look at valuations. Looking at an election, a presidential election year, just anecdotally, since 1988, the S&P averages an annual return of 4.9, excluding the 2008 crash. The annual return is 10.9. Case A shows the S&P at 33.75 from here. Case B shows it at 35.68. All right, now for our action call, our buy recommendation. It's a company called Travel Centers of America, symbol TA. It's the big TA you see as you drive on the freeway when you're traveling, and that's why it's called Travel Centers. They offer a range of products and services, truck stop, restaurant, gas services. They operate in 44 states and Canada. They are known for their restaurant brands, proprietary brands, Quaker Steak, Lube, Iron Skillet, and Country Pride. We believe it's undervalued, virtually priced to go out of business. Trades about 0.2 to book value. That's right, 0.2 to book value, and about 3 times EBITDA. It's virtually a fire sale here, and they just raised some cash that'll get them through the pandemic. Cutting costs. They're branding their restaurants, a good portion of them with IOP to share the management expense there. So valuation, you add it up, you put it somewhere close, even at a 30% discount to its comp group, and we get a $30 stock, and priced at $14, $15 in this day and age. That tells me there's good upside in something that has been thrown away, discarded, while the market has congregated in the stay-at-home stocks and the FANG. The risks are the price of oil continues to plummet, and the quarantine lasts longer than expected. So for more information on Travel Center and a complimentary trial, visit us at Singular Research at seekingalpha.com. Have a nice summer and happy trading. Thank you.